Okay, so I think we can start now the afternoon part of the workshop. And we have this session number 2, where we will have Vladimir Sokolov presenting his work, high-yield deposits and financial stability. And I heard this was specifically later for this workshop. So
I was about to say something like along those lines.
Okay, so Vladimir, the floor is yours.
Thank you very much. Yeah, my name is Vladimir Sokolov. I'm from High School of Economics, and this is joint work with Lucy Chernykh from Clemson University. And as Susanna said, that this is a very recent paper. We've been working on a similar project, and the data set which will be used here previously, but this is the offspring from the larger project. What's the motivation for this paper to study high-yield deposits and financial stability? So first of all, we take our inspiration in some theoretical work, which is maybe by now a little bit old, but nevertheless is still, we believe, quite relevant. So it's an AR paper by Hellman and co-authors, including Joseph Stiglitz and late Sudipta Bhattacharya, 1982 paper, where they show that in the classical moral hazard problem, which everybody in banking literature is familiar with, the situation might occur when banks settle for so-called, as they define it, the gambling equilibrium. So there could be good equilibrium and gambling equilibrium. And gambling equilibrium is when banks do classical moral hazard risk shifting. So they give out risky loans, and in case they pay off, banks stay and rip off the returns. In case loans don't go well, it's the insured depositors who pay for this, and eventually the taxpayers. And one of the solutions, and they describe the situations when banks will be lured to increase their deposit, insured deposit funding through aggressive competition on the deposit market and offering high deposit rates. And actually this paper by Hellman and co-authors stresses that this problem is most likely will be quite relevant for emerging markets. So they explicitly say that for more developed markets there would be maybe some institutional features to prevent this, but in emerging markets that could be quite a significant problem. And they build a theory where they suggest that a solution of this to impose explicit deposit rate ceilings. So as you might know, there is a lot of debate about banking regulation these days, but this particular regulation I never heard recently being discussed. And I guess it's the reason because most of developed world lives in the world of zero interest rates, and high interest rates is not a problem. While in Russia, which is an emerging economy, that was a problem, and we empirically show you the situation where banks compete with high yield deposits, and actually the Central Bank of Russia, the regulator, will impose the interest rate monitoring or some kind of interest rate ceiling. Okay, so this is our main motivation. Our second motivation comes when we think about this, comes from another literature, which is not particularly on banking. This is more general economics and finance. It's a team of researchers, Bardala and Andrei Schleifer. So they developed a theory of competition for attention. So in a nutshell, this theory builds a theoretical model where generally firms attract customers by drawing the attention to specific salient features of those products. And 2013 AR paper is devoted to finance, and they build a model where they show that firms might draw retail investors' attentions to payoffs with, again, salient features, and investors will overweigh those payoffs and will structure their portfolios in such a way that those assets will be overweight. So the idea is that firms, banks, financial institutions can sort of manage people's attention and compete for this attention by drawing attention to particular salient features. In our case, this is particularly relevant because when you see banks advertising their deposits, you always see the headline rate. And the headline rate is usually the maximum rate out of a range of deposits products banks offer. And we claim that this is a related case when banks draw retail customers' attention to this particular silent feature, the maximum rate on the deposits products they offer. Okay, why it is important in general? Because as you see, we have a situation when banks aggressively attract funding on the deposit sides, and then there might be a problem of risk shifting on the asset sides. So, and this is quite typical banking problem, and there are quite a few studies, which I'll review in the next slide, which looks into how funding costs and on the liability side and bank solvency on the asset side is related to each other. And recently, of course, the stress testing exercises by central banks were quite attentive about this issue. Brief literature review, it's related to the motivation of that paper. So you can quote quite a few theoretical studies on deposit insurance, some earlier, some later. The list is absolutely not full. There are more papers on this. But in general, it's a classical situation of a moral hazard in the presence of deposit insurance. And I guess you're all familiar with this setting. And then there are more recent empirical papers which demonstrate that indeed cost of funding and bank solvency are related. There are papers by IMF researchers, a recent IMF working paper, molded papers by DeYoung and co-authors. This paper in the GBF related, looking into cost of funding through the wholesale market, how is it related to bank solvency, and recent paper on deposit insurance in the United States, how it affected, again, banks risk-taking, and they show that changes in regulation in the US affected risk-taking by banks. And finally, again, literature I cited previously by Bordal, Andrei Schlaffer, and other co-authors who, in our setting, we argue it's bank aggressive deposit taking draws attention of investors through advertising maximum headline deposit rates. Having said that, what is the regulatory environment which we will be operating? So, as you might guess, our paper is on Russia. We're looking at the period from 2012 until mid of 2015. The beginning of a sample is determined by availability of deposit rate data we started collecting. And mid of 2015, it's the end of so-called fixed rate deposit insurance system. So when banks participating in deposit insurance paid fixed rate. And there was a lot of policy debate about that time, saying that safe banks, large state banks, they're basically biggest contributors under that system, and small risky banks are free riding on them. So since mid of 2015, that's where we end our sample, the risk-based premiums for banks participating in deposit insurance system were introduced. So banks started paying differential fees. And then a second regulation, which is most central to our study, is that throughout the whole period, it started earlier than this in 2009, and it continued until the end of our sample, the Central Bank of Russia was conducting the policy of maximum deposit rate monitoring. So the central bank each period of time calculated the so-called benchmark rate of top 10 banks by asset size. It collected the data on their maximum deposit rate offered, calculated that benchmark, and then allowed a margin of 2% for the most period, and then 3.5% margin for the latest period of our sample. And if other banks exceed this margin over the benchmark rate, then the CBR would send the regulators to seriously overview the bank's business model. So we are not aware of other material penalties which would follow. All we know from regulation that regulators will come to the bank and open their books, basically. And that should be a threat for banks not to exceed their deposit interest rates over top 10 banks benchmark plus 2%. Okay? What we do? So we use the deposit product level data in order to extract the maximum deposit rate, which is subject of the central bank's monitoring, and study how variation of that maximum deposit rate for each bank quarter observation in our sample, how it's related to a number of outcome variables. So in those outcome variables, we roughly group in 3 groups. So first we look if maximum deposit rate is related to bank's growth and profitability. Second, we look at the asset composition because we want to identify if there is this so-called risk shifting problem. And finally, we look if this maximum deposit rate is correlated with the likelihood of banks' failures. Because over that time period, quite many banks lost their banking licenses. There was a big wave of banks' licenses revocations. And in each of this subset of questions, we also look into by how much the maximum deposit rate offered by this particular bank exceeded that official benchmark plus threshold in order to see if the regulatory framework was indeed having any effect. So let me first tell you a little bit about this deposit level data. So by Russian Civil Code, banks should publicly reveal their deposit products features. They must publicize all the deposit products they offer because they're qualified as as public contracts. So they disclose all the terms on their websites and on the different aggregators. So we use one of these website aggregators, Yandex.ru. It's a major Russian search engine. So in the team of our assistants, they use the web scraping techniques for over this time period every month to collect all data on each bank's deposit products offered. So we assembled this data and we still keep assembling this. And then having this information, we're able to, for each bank quarter observation, to at the end of the quarter, to identify maximum deposit rate offered by each bank, which is subject of the regulator's monitoring. So let me just give you a snapshot of one of the data points. So this is just example of the data we have and what we would use here. So let's say we have this Renaissance Credit, some commercial bank, and it would offer a range of deposit products. So here are sizes, here are maturities, here are interest rates. So this bank offered 4 types of deposit products. One is called profitable. So this deposit product is oriented at people who want to save for particular maturity, particular target. So usually these deposits would have features that you would not be allowed to add money or withdraw money from this deposit. And amounts vary for different target groups. And usually if you compare with others, normally interest rates are a bit higher. Then there is a convenience, so such deposit would normally have some features that you could partially withdraw money without losing your interest rate, you could add money. So it's for people who want to have it earn some interest, but also manage. So there is a high likelihood. I don't list features here. It's a subject of other research. So normally people who would have some more convenience with the money, but they would trade off a bit interest rate. Then something for pensioners, the interest rates are lower, but the starting amount, 3,000 rubles, would fit most of the income. And then finally, something called perspective. It's, you see, large denomination relatively, and only offers one maturity of 1,100 days. And it's particular for people who want to lock into this interest rate for this period of time, and they don't want to be subject to interest rate fluctuations in between. And so out of all this information for our this project, we will just extract this data point. So we take the maximum rate offered out of this all deposit rates offered by this bank in this period, just that 12%. Because that's actually the rate which normally this bank would put in their advertisings. Even if you're a pensioner and you would come and just put 3,000 rubles for maybe 3 months at 8%, but the headline rate will be always 12. So you would see the ads saying we offer up to 12%. So this is the salient feature of this deposit product, and this is actually what the central bank monitors as well. So that's why we're only interested in this data point. So this is how our data looks like. So the dark lines are just the medium of all the maximum deposit rates, the 10%, 90%. So this range of how they fluctuate, and there was some small crisis at the end. And then this is a regulatory benchmark, which is top 10 banks, and it's publicly stated on the website of the central bank. So black lines is we are available to you calculate from our data set, and red line is official. And green line is that additional margin threshold. So you see a threshold is quite close to the median. So if you're below threshold, you're fine, and if you're above threshold, then as the regulations say, central bank would send a team of examiners to look at your business model. So bank level data is the usual, as most researchers who use Russian data use. It's a balance sheet, income statement data, quite many accounts, so that has a time frame. So we have 555 banks and this many quarter bank observations. So descriptive statistics, this is just this maximum deposit rate in our sample, varies from 3 to 23%, median are quite close, about 11%. So only about 16% of observations are above the benchmark, 84 is below, and here is a breakdown. We create some brackets. So basically about how many, 60% of observations are above the benchmark but below the margin of 2%, which is allowed. So that's where most banks are. So they're slightly below the margin and above the top 10 banks. And then those who exceed margin, regulatory margin, is about 25-26% in our sample. This is data which is our dependent variables. It's growth of household deposits, growth of loans, growth of a change in costs of deposit funding. This is implied costs from income statements. And this is implied yield on loans, again from income statements. Then we can calculate net interest rate margin, and then usual ratios, loan to assets, investment in securities to assets, cash to assets, and so on. And then we also collected data on banks' failures. So there were quite a few failures in our sample. I think here I don't mention how many overall, but it's about, so we look at 2-time windows, 6 months, failed within 6 months, and 1 year. And Central Bank of Russia gives 3 reasons why the bank failed, and then non-mutually exclusive. So sometimes they overlap. Sorry, yeah, I should hurry up. So these are the reasons. So here are the main results. I'll go quickly because I have 5 minutes, but you will get it quite straightforwardly. So our main variable of interest is this maximum deposit rate quoted, offered by this bank in that particular quarter. So we have about this 5,000 bank quarter observations overall. So this is just OLS regression with time fixed effect. And here we look at banks' growth and profitability. So we look at household deposits growth, loan growth, then cost of this household deposit, and yield on loans, and net interest rate margin. So all of them are positively related to maximum deposit rate offered by the bank, and net interest rate margin is negatively, but only at 10%, significance related to maximum deposit rate. So we, in our paper, we sort of take it as first evidence that this drawing high yield deposit helps banks to grow, but not fast enough to compensate the also growth of costs on loans. That's why banks, in the end, they have a net interest rate margin being negatively related to this maximum deposit rate. So it's a dangerous policy to pursue by the bank. Then we continue the same analysis, but instead of taking this continuous measure of maximum deposit rate for each bank quarter observation, we create 4 dummies. It like gives us the band around the benchmark. So this colored segment represents if benchmark is exceeded by 1.5% and more. So benchmark is 2%, threshold plus 2% above the benchmark. So here the regulators will come to you. So it is a dummy variable, 1 if the observation falls in these 2 ranges. And this is below threshold but above benchmark. And the reference category is top 10 banks at the benchmark. So everywhere we see that, again, the dummy variables representing by how much banks exceed the benchmark, in which bucket they would fall, is positively related to growth and costs. but for the highest group, negatively to net interest margin. Then we look at the composition of assets, and here we look at the usual variables, loan to firms, loan to households. Why we look at specifically loan to households? Because anecdotal evidence suggested that banks take household deposits and then give a lot high yield household loans, consumer loans. Somehow we don't find any evidence that there is significant relationship between advertised maximum deposit rate and loans to household. However, we find that investment in private risky securities significantly related to this maximum deposit rate, but investment in government safe securities is negatively. So it's some kind of evidence of risk shifting by banks. And cash is unrelated. We do the same analysis again through these dummies buckets, and we find similar evidence that buckets which by far exceed the benchmark and threshold, they're positively related with investment in private risky securities, negatively with government safe securities. And finally, we come to the last part of our empirical analysis is when we do logit regression a la De Jong and Torna, Koen and other courses. He has a number of papers when they look at how banks' failures are related to different bank characteristics. So in this case, we take the usual bank characteristics, and I never commented on them, but most of the signs are quite intuitive and expected. I only draw attention to this maximum deposit rate, which is novel feature of our analysis. So we, in that framework of De Jong and Torna, we look at different time windows, 6 months, 1 year, and we find that in 1 year lagged. 1 year, if we take a year data before license revocation, we find that maximum deposit rate is significantly positively related to the likelihood of banks' license being revoked. Here we split it into the 3 different causes, and in all cases it's again significantly related. And then we do the same for these dummy variables representing margin by which the maximum rate exceeds the regulatory benchmark. And again, we find, and the relationship is positively increasing for all these dummies, and specifically we find that for the case of insolvency, the reason of insolvency, maximum deposit rate is significantly related to the likelihood of bank's failure. So we treat it as follows. We treated that regulation is correct, that banks, knowing their business model, they try to attract insured deposits through high advertised maximum rate, and in a way it sends a signal to a regulator that there is something is wrong. So that regulation, that the monitoring the rates is right, because in the end it turns out that yes, those banks in the sample which offered high rates, advertised maximum rates, they're significantly related to probability of the failure. These are preliminary conclusions. It just lists all the results, saying that let me just in 1 minute summarize. We show that maximum deposit rate advertised on retail deposits to households is significantly positively related to banks' growth and profitability, but negatively to interest rate margin. And then it's not related to composition of loans, but related to composition of investment in securities. So banks tend to invest more in private non-government securities. And finally, throughout different windows, we show that probability of bank's failure, license revocation, is also significantly related to this maximum advertised deposit rate. Thank you for your attention.
Let's try to do it in about 7 minutes.
You said try, right? I will try. Okay, so thanks for having me. It's always a pleasure to be here. Let's jump in it right away. So I find it a very interesting paper. I think it's interesting and intuitive. I think it's something you want to know the answer to. So it's an important question. And the results they find are generally in line with the model of Hellman, Murdoch, Stiglitz. My main comment is going to be that they're in line with the wrong model. I think they need another model with the same results. So I would write the paper in a different way, but I like the results very much. So let me talk about the model therefore. Right? So this is the idea, the framework of Hallman-Murdoch-Stiglitz, right? You have free deposit rates instead of deposit ceilings, and banks can compete on the deposit market by increasing deposit rates. This leads to more risk. This we call risk shifting. So the banks are going to compete for the deposit market by raising deposit rates, but then they have higher cost, and they need to finance this by increasing return on the asset side, and they do this by taking more risk. If the dice fall well, if you're lucky, this is all perfect. If things go wrong, the deposit insurance pays. So in the end, this is a story about moral hazard, and what the big three say is essentially you can solve this problem by turning to deposit rate ceilings. So in this paper, they propose deposit rate ceilings as a policy, and in fact, why did they do this? In the US, there was such a policy. It used to be called Regulation Q, and it was abandoned, and after that we got the savings and loans crisis. So that's the background against which they write this paper. So this is the story. What do they find? And this is like a one-slide summary of the paper. They find indeed that this higher maximum deposit rate, which is in the paper the measure of raising deposit rates and in fact of deposit market competition. You could think of other measures, I think, but that's the measure they take. With the salience argument, they see, okay, deposits and loans grow more. I wonder why you don't take assets. Because in the end you find it's mainly in private securities, in fact, and not so much in loans. So why not look at assets instead of loans, and then look at the composition of assets instead of at loans in the first table. They find there's a higher cost of deposits and a high yield of loans. So it costs me more to compete for deposits. I turn it into higher yielding loans, that works. But however, the cost of deposits increase is higher than the yield increase, so the net interest margin falls. And on average for banks, they're worse off. This is very much in line, by the way, what happened in Sweden in 1991 with the Swedish crisis, when there was a liberalization of interest rates on deposits and loans, and you saw exactly this. You saw higher deposits, higher loans, decreasing net interest margins, and then the crisis. So these things have happened before. So you see, especially there's more private securities and less government securities. So I would therefore look at assets first, and then they see that there's indeed an increased likelihood of failure. These banks that have the highest promised deposit rates exactly are more likely to fail within the year. So what is the theory? The theory is like this: you get deposit insurance because of this small hazard. So I'm going to increase my deposit rates. I'm trying to poach the market, and then I will pay this by risk shifting, which means higher growth of deposits and loans, which will mean lower net interest margins, and therefore ultimately failure. This is the logic basically of the Hallman-Murdoch-Stiglitz paper, and that's the logic they claim to find in the paper. What I will do is challenge the timing. Although with the same results, I think the timing is very different. And there's another framework of the paper, right? In the paper itself, there's a quote. I quote the paper, I found that, I said, this is what I want to say, so I just quoted. Suggesting that 1 year prior to license revocation, banks management foresees the future insolvency problems and starts increasing the deposit rates in order to secure insured deposit funding. But this is a very different framing. This is very different timing. It's a different story. This is a story about gambling for resurrection. Nothing to do with Hallman-Murdoch-Stiglitz. It's about banks are in trouble. They see, oh shit, I have to do something. They say, what could I do? Oh, I'll just promise higher deposit rates to attract funding and save myself. If things go well, great. If things go wrong, well, deposit insurance will pay. And it's a different story, but it's the same results. So and I think this fits the story very well. So then this timing of this story is, you have economic problems, you have the recession already starting in 2013, getting really bad in 2014, 2015. It was aggravated by the Crimea crisis, but it was already happening before, as we all know. Because of this, banks start to see solvency problems. They react to this expected insolvency by increased deposit rates to the kind of grabbling funding. If it works, they have successfully gambled for resurrection. If it fails, too bad, the insurance will pay, and that means you have both an increased likelihood for resurrection compared to the start, but also an increased likelihood of failure. Right? There's a whole literature on this gambling for resurrection. But it seems that the results are at least as much in line with this whole set of theories instead of with Hellman-Nordbrook-Stiglitz framework. This would be the CBR instead of OCBR. Now, I would like to refer to my self-serving comment to my own paper. It's gonna lag, okay. In an old paper in 2010, what did we find? We find that in Russia, if this is the deposit growth and this is the deposit rates, something like this is happening. You have a backward bending supply curve. This here was at the 6%. It turns negative from 12%. So there are decreasing returns to increasing interest rates, and they ultimately become negative. The argument of the paper is, why is this a backward bending deposit supply curve? Because in Russia, quality is very hard to observe, but depositors, especially from depositors, think of the deposit rates as a signal of otherwise unobserved quality. If banks start increase deposit rates much more than others, everybody knows they just promise high deposit rates but never intend to pay them. They intend to run with the money or save themselves, and everybody knows this. And that's why promising very high deposit rates before deposit insurance ultimately run into negative returns. Banks that promised many deposit rates, they were failing, and we found this backward bending deposit supply curve. Now, what would happen, imagine if you introduce deposit insurance? This part will disappear, right? Because if I'm a depositor, I know that if the bank promises 12%, I might not get it, but the deposit insurance will pay me, because I'm insured now. So as long as I'm below the threshold, it will go like this. But the central bank still knows this. So the central banks, they cite this paper, that's why I know they know this. So the central bank would still see, okay, if interest rates are very high, I take this as a signal of bad news. So basically, the policy of the central bank you're talking about is very interesting, but I think it's more about, as you also suggest, it's not about deposit rate ceilings, it's about the central bank knows it's a signal of quality. And so if you have really high interest rates, they will start an inspection, not because there's risk shifting and they fear Hellman-Nordbrook Stiglitz, but because they think, just there's something is wrong here. These guys are in trouble, because that's why they raise interest rates. It's a signal of quality. So I think I like the results very much, but I really believe that there's a different framework, which is equally interesting, or at least more insightful for the Russian story. I finish.
Thank you. Thank you. So now I think we will hold more questions than to answer. So if you have any questions, comments.
Yeah. Are there any other countries which introduce this different state?
I
know that you
I'm only aware of Regulation 2 in the United States. Found in other countries doing this. And as I said, probably it's irrelevant for most post-crisis developed world, but maybe some other emerging market countries. But I'm not aware of Regulation to build up some stories.
How you position, how you sell the paper, right?
Yeah, you're right. Yeah, I should investigate it more.